Hi, everyone, and welcome back to another show. My name is Tyler, and I'm here with Matt, the founder of ORATS. ORATS is an options analytics platform built on top of over 15 years of historical options data. Our dashboard is integrated with Tradier, meaning you can research and discover trades on our platform and then seamlessly send them through to your Tradier brokerage account. Today on the show, we're going to talk about how to use theoretical values in your trading. We're going to look at the stock and option scanners in the dashboard and probably put on a trade. Matt, do you want to jump in and share your screen and get us started?
Sure. Yeah, I wanted to start off though with last week we talked about trading plans, and I thought about it more. I go, well, how am I using it? And we've talked a lot about how to use puts and how to protect portfolios on the shows here, and we had a big correction with the tariffs and then a big comeback, and I didn't do as good as I should have done because I was set up very well for the tariffs, made a lot of money, monetized, a good half of my positions. So what that means is, I had put spreads, put calendars, and just some long out of the money puts. Um, and I used to do what was called garbage VIX puts. So we could talk about that maybe in a different show, but it's just very small, priced way out of the money, like hundreds. And you know, again, what I always say is it doesn't need to go to that. The VIX doesn't need to go to that, but if it's going up, those things start to explode. So I had a bunch of trades on and monetized it and was feeling pretty good about myself. And then, got it pretty good where the market went up after I monetized a bunch. And then I re-put on probably too much, feeling, my oats a little bit. And, it didn't do as well. I was a little disappointed. Didn't do as well as I should have on the monetization. And then I thought, well, if I would have followed my trading plan a little better, I would have done better. And I think, I've been in the trading business for a long time, and that's a familiar refrain is like you have a good plan, but you don't follow it. And so I was guilty, especially like the week after we talked about it all. So um, just shows the importance of following a trading plan for those puts. So trying to be a little bit more disciplined on not, you know, if you have some success, don't get overconfident. The market's always going to come back and bite you. So you got to just stick to a plan. And I think that's kind of the lessons that I've learned and tried to convey it last week on the show, Tyler.
Yeah, thanks for talking about that. I think trading plan is super important, and that's what the dashboard sort of built around is helps you execute this trading plan with our four pillars: research, implementation, risk, and review. So the scanners are a big part of that, and that's what we're going to talk about today. A lot of theoretical values and stuff like that.
Right. So today um, we want to talk about theoretical values. There are theoretical values are a big part of the execution and also the research pillars that we talk about. The research pillars in that you may use your forecasts of volatilities that ORATS does based on historical and some other information, and also using smooth theoretical values. That's based on ORATS proprietary SMV process, which is super important, and that we implement also in the backtester. So one of the things that we do in our backtester is consider the SMV. And when I say that is it's very important when you're backtesting to consider what you think the fair value of an option is, because you could a lot of these backtests that I see people doing are thrown off by assumptions of where they could get filled, especially on wide markets, and especially when they're closing out a position. So when you're at the money or near the money and you're putting up, and there's a lot of time left, yeah, there's a good bid ask. But as time goes by and it's short dated, market makers, which I used to be one, will widen out markets because there's so much gamma risk and such. So when you have wide markets, you really need to consider the smoothing. And I'll just kind of point out something in that real quick, Tyler, if it's all right.
Yeah, let's get into it.
So SPY probably isn't the best example, but here's, this orange line is our smoothing line. So what that means is we get the cyan, which is call implied volatilities, and purple, which is put implied volatilities, and we line them up. We have a ton of information on the S&V calculation, but lining those up, getting the right interest rates, the right dividend assumptions, a very important part of that. And then we draw a smooth skew through the calls and puts. And you can see over here, it's more weighted towards the calls, like so you can see the orange line, because if you think about it, these puts, the price of these puts is very high. So what happens is market makers will widen those puts out because there's a lot of delta risk for them. Whereas the calls might be, 5 cents at 6 cents, and these might be $12 at 12.05 or something like that. And the vega is very small in those, so that's why you see kind of a divergence in those. Can you see those okay on my screen? Here, I could zoom in a little bit, kind of point them out over here.
Yeah, it's neat how you can zoom in on each individual section.
Yeah. So yeah, like I said, it's 3 cents at 4 cents and 8.07 at, so that's 9 cents wide on the puts. So you don't want to, the S&V knows that. So you don't want to utilize the premium in the puts to draw that line. Does that make sense, Tyler?
Yeah, so going back to the S&V, like we're sort of smoothing the whole volatility surface, right? So we're ingesting the real market and then kind of coming up with a whole new volatility surface, and that's kind of where we reflect these theoretical values in.
Right. And and again, one of the points of that, on the wings, you want to look at the smaller priced option in order to kind of draw your skew. Meaning, like way out here in the calls, 3 cents at 4 cents is a real market. The extrinsic value in the puts are still probably 3 or 4 cents of extrinsic value, but it's a lot wider. 9 cents wide on a 1 cent wide call premium. So
interesting. So
yeah. And the opposite thing happens on the puts. The puts will be very wide. That's 9 cents here on this 586 put, and the market's 9.10. So the S&V knows to draw that through the puts and draw this through the calls more, when we're doing our smoothing.
S&V it sounds like a very smart system.
Yeah, I mean, it's one of the hardest things that I've done as a researcher, market maker, all that is this type of thing was very difficult to get all the rules in there. I mean, past market makers will know what I'm talking about when there's so many little especially if you're making markets and putting theoretical values out there on every strike. That's the hardest thing to do, and market makers still face that challenge, and they have a lot of rules, and now it's pretty incredible what market makers use to make markets. They have all these rules-based systems, and it's quite a feat what they do, and ORATS tries to do that with our S&V system.
Great. Yeah. So how does an ORATS user utilize this S&V in their trading? Like
Right.
it's great to see it on the volatility surface there, but how would I trade around it?
Yeah, so it's a couple ways. Well, I'm going to show you, since we're on the chain, and chains are one of our more popular tools. We'll start here. So you'll see like we'll start on the put, since we were just talking about the bid ask and then the S&V. Okay, so near the market's bid at 108, ask at 109, mid market is 108 something. We round that. Now it's moving around, but the market is slightly lower on that one. So if you're buying that, you're going the wrong way according to our S&Vs. You'd rather be a seller, since we only have it worth 103 now. It's skipped to 106, still closer to the bid than the ask. So that's one way. Do you get that?
Yeah, I mean, it looks like it's jumping around a lot too.
It's jumping around, but it's staying. So we're more of a seller of this 592.
Hmm.
So that is what the SMV is kind of saying right here. And we're going down, and okay, okay, this is a good one. So the 582 are 3 cents at 4 cents. We have them worth 3 cents. This one has to be worth less, but this is the same. It's 3 cents at 4 cents. We have them worth 2 cents. So, this is the SPY is very tight, and it's probably more meaningful on less liquid stocks, but this makes a good example just to show you how fine that you could get with your theoretical values. Again, very difficult thing to do, but I think it's pretty amazing how close that stays. And so when you're trading, you would take a look at the S&V, and when we do trade, when the trade ticket comes up, even with spreads, you could then see what the S&V is versus what you're paying, and that's a very good way. That's one very good way to use it.
Yeah, I like looking at the chain, and it kind of using it as a gauge to see as what I'm trading super undervalued or overvalued, and it's kind of interesting to see when it's outside the bid and ask. That's kind of an interesting tell.
Yeah, and again, the S&V is within the bid and ask. Depending on how you measure it, 98% of the time, just very high
Yeah.
amount of time within the bid and ask.
And this is a value that we offer in our derived API, right? And that we've talked about that, I think, a show or two ago.
Yeah. So the derived API, like its name says, is something that pros or programmers can use to, if they don't need a totally accurate bid ask, they don't need volume, if they don't need totally accurate stock price, but it's just something very close, you could use our SMV values. And so, it's a lot less expensive than going with, Oprah when you're developing or whatnot. So yeah, and you can see how accurate they are. So it's a very important number, technique in order to develop these theoretical values that you could use in lieu of having bid ask prices that are very expensive.
Right. So the SMV or the S%, that's just one of our theoretical values, right? We have two more.
Right. And while we're here, we do have a forecast fall. Now, in contrast to the SMV or S fall, the forecast or F% can and often does vary from the markets. So when people say, hey, the vol's cheap or the vol is expensive, what are they talking about? Okay, well, they're talking about, versus historical volatility, which is a name is statistical volatility, and or the history or the recent history of implied volatility. Like today, market's down a little bit, vol's up 3%. So, we might be, we're saying that our forecast is below. So our forecast is 15.7, and the volatility at the SMV is 21.9, about 22. So, and that's what, the bid ask is about 22.1. So, the forecast fall again looks at historical volatility. We could go to the trade builder real quick to see that. Volatility still come up, but if you look at like a shorter term measurement of volatility, even the 1 day, like yesterday, ORATS has a historical volatility that's based on a Parkinson calculation that gives accurate 1 day volatility. So you'll see it, spike up here, and if you're looking at a 20-day vol, it takes 20 days for it to come back down. But this is more down in the 12s, and almost single digits.
Wow.
For the actual vol. So that's why our forecast is low.
Got it.
So I think this is a good time to go, okay, well, if we go to the stock scanner, we could find stocks that either are overvalued or undervalued based on forecast. And then we could go to the option scanner and find options that are under or overvalued based on S percentage, and we'll introduce a different percentage that we only put in the option scanner because it's a very labor intensive or computationally intensive calculation called D percentage or distribution. We'll show later.
So
So,
Matt, this forecast vol, is this the same using the same volatility service that we sort of recalculate from the market data?
so I think your question is our forecast, like our F percentage. What does
Yeah.
it use? What does it use to calculate that forecast? Is that what
Yeah.
you're asking? Yeah. So it uses the S percentage. So it uses it uses this, but it uses the it to calculate a very accurate at the money volatility. So what it's actually using, it's using some of the 1 day. So this is coming down, so you can see our forecast is right around here. Volatility is coming down. It uses that. It uses short-term trends, long-term trends, and then it makes its forecast of volatility. I could even. So ORATS forecast 20-day. And so you could start to see, from the forecast. So we use historical volatility, and you could see that as the volatility started going up, our forecast kept going up, right? And so our
Right.
forecast was way up, and then as it started coming down, then our forecast comes down. You might say, well, it's a little slow, but it's kind of marking the market, following the market a bit. But that's what that's when people talk about how do you measure what the volatility should be. There has to be a little bit of a lag, but you also want to try to get ahead of it. But but also that's part of our kind of new thing that's coming out. Our trade chart uses technical analysis on top of these things, so you could start to look at what are effective other ways to use the forecast other than just what we're seeing right now, like the at the money or what its current projection is. You could start to see momentum and which way momentum's going off, and that is a good indication of which way the ball is going in a particular stock.
Yeah, I'm really excited for that tool because we're going to be able to measure, like things like technical indicators on top of the ORATS indicators, and we're really going to get some insight on how that impacts back testing and forward testing and all that. So,
Right.
very excited for that.
So, let's look at a scan. So one of the we have templates in our stock scanner, and I'm just looking at it by cheap calls on these types of stocks. So this is the forecast. So the forecast divided by the implied volatility. So the forecast is much higher than implied. So you want that's 10%, 1.1, 10% over. And then where the historical volatility is greater. So these are a lot of things that might find stocks that are kind of ready to go, right? So if we look at Kroger, we could see that the forecast of volatility is higher than the actual volatility, and when you click on that, you can see where it's been historically. So it's a handy item to see what these stocks are looking like. But you can tell that that was one of our conditions that we needed the ORATS forecast to be higher than the implied. I'm actually going to sort on that because this is what this isn't the sorted one. What if there are more than 25? That's what the option scanner uses, Tyler.
Yeah, exactly. So, oftentimes a stock scanner you'll have hundreds of symbols in there, and if you import this list into the option scanner can only take 25 at a time because it's looking at the entire options chain for each of those symbols. So, if you sort the column in the stock scanner, when you import that scan into the option scanner, it'll use that sort. So, it's oftentimes a very good tool to use for that.
Yeah. So what Tyler's talking about is sometimes you get this one doesn't have that many because we have some pretty tight indicators. But if you have 100 results, you want to sort this based on your favorite or what you're really looking for. In this case, it's the forecast. So So now what we could do, and I saved it. So now what we could do is, go over to the option scanner and say buy cheap calls on these. So we're gonna go over to the option scanner. I'm gonna clear out everything, clear all settings, and I'm gonna go choose a stock scan when we're adding symbols. So 1, 2, 3. It's 1, add symbols. So which symbols? Buy cheap calls on these, and they're the same ones. What strategy? Well, we want to buy a long call. We'll buy cheap calls, so we'll buy it with the delta that's lower. Tighten it up and lower it again. So these would be pretty far out of the money, and I could widen this out to like 15 to 99, and get some pretty wide or pretty good stocks. So yeah, so let's start looking at these. KMB long call. So it's a 148, not too far away from that. So this has now a D percentage. So let's talk. This is a new theoretical. We know what the F percentage is. These are going to be awful high, right? We already know these are going to be high because this is what we've sorted on. So
yeah, that's the stock scan.
yeah, so this is what the stock scan does. So we have a pretty active community, and it's been great lately. And this is one of the questions is, how do I sort on all options? Well, we try to make you a little more disciplined. Like, first, you're not going to trade any option, right? You're going to trade only a subset of symbols, and only a subset of those symbols you're going to trade.
Right.
So if you're looking for, so you can open a bunch of different tabs, but for a call that you want to buy, you want to find very specific things. So we're essentially scanning on the entire option market, but we've disciplined ourselves to find stocks that we only want to trade, right? So, and these are some inexpensive stocks that we could find too, and the price of these you could even set. So, maybe our price percentage, like here's one that goes from 20 to 54. We could set those. Clearly, you're going to want to set your market with, like, this one's way too wide.
Is that part of what the S percent is supposed to help you do as well?
Not really. The S percent looks at the difference from the mid market, okay. And it likely will save you from those because there's so much variability. Mm-hmm. But you kind of need both. So clearly we want to filter this one out, but let's just look at that real quick. So this is KMB. The market's 30 at 75. So the market maker's just going, I don't care about selling these, like the theoretical value of this is 41 cents. So we're not going to buy it for, we probably wouldn't get filled at mid. We'd probably get filled at, or actually on these, you have to watch out because the market makers have a SMB value themselves, and it's often pretty close to what ORATS has. So, you don't want to give up 20 cents on a little call like this. So this is something that you definitely want to filter out from your system. So how would you filter this out? You would filter. What I like to do is I like to say, well, these are pretty illiquid, so I'm going to go negative 2% to 2%. So you could tell that these, filtered out a lot of those. And again, before is this, it says 13% of edge, 12% of edge. Those aren't real. So you don't want those markets that way. So I go 2 or 3% depending on how wide and how liquid these are. For SPY, I'll be like 0.5 of a percent. But let's just go to negative 2 and 2 again.
I mean, I think it's really cool that you're bringing your knowledge of market making into all the stuff we do at ORATS, because retail traders, I can't think of another platform where retail traders have access to this kind of institutional knowledge built in, like to the core of the product. Yeah, I mean, you would have to move up to really professional products, right. Like SpiderRock or I think some SIBO products might do it, but yeah, on a level like this, this is really what professional traders use in order to find opportunities that are real in the market. So now
what I've done, Tyler, is I've set a limit on how wide the market could be, like
Yeah.
0.2 of a volatility, and then also on our S percentage. So we talked about the S percentage. That's our smoothing. We want to be within 2% of our smooth value, right?
Right.
So now we could be a lot more confident with these markets. Like, now here's that same KMB. If we click on it, it's 25 at 40. It's not 35 at 75, right? This is a more of a real market. It's right at the theoretical smooth edge. So this is more tradable, and where you have more confidence of getting in and getting out at a reasonable level.
Mm-hmm.
So that's the first thing. So let's talk about now. So we've talked about S. We talked about F. That's how we kind of got all these, and there are different Fs here, for different stocks. And then, actually, why don't we talk about F for a moment? Because KMB, this is an awful high F percentage, right? So
It is very high. Yeah.
right, and that has to do with one, it's a small number, but two, and we'll go to the cool thing is how dialed in and linked in the dashboard is. So you could see, okay, this is the one right here, and you could see that for KMB, the forecast value is 21, and it's 15.9 in the market. That gives you like a very high theoretical value, but you could see, that KMB, let's just look at how, the skew is a little bit wonky. See it. So we're way out here, right? This is that green circle. I don't know if it's a little bit difficult to see. Let's see if we can blow it up. So this is the one, it's undervalued. It's under the line. So there's a little bit of smooth edge. And we have the forecast. We have the skew really going up over here. And it's not really doing that in the market. Meaning, we have, you'll often see a smile. There's no smile in the market right now, which is why we kind of like this call. You see that?
Yeah. Typically, you'll see both the wings kind of going up, but it kind of flattens out. It's like a left skew a little bit.
Yeah. So you'll see a smile like this sometimes you won't. But anyway, so we like this, so I like this call, on a number of levels already. So I think this will probably be one of the trades that we put on here. We could go back to the option scanner, and then, or actually go to the option chain, see what our trade is. So our trade, I'm pretty happy with this. We probably have to give them a couple cents. This is an interactive broker, so I'm going to switch my positions to the paper trading. And I think we could probably fill at 35 on this market. So why don't we force that? Now, of course, we're long. Of course, it's way out of the money at 149 versus 141. But we have some time. We have a month. And so, again, I think it's this is a good shot to take.
Yeah. So did we talk about D percentage yet?
Oh, no. Thank you for bringing me back to reality. I thought I was going back for a reason. All right. So, so we've talked about the smooth. We talked about F. We talked about F in terms of just the at the money, but this is also a skew kind of play. So, for the F percentage, we not only forecast volatility, but we forecast skew and long-term volatility. So that's and earnings. So we make a complete forecast of the volatility structure, that's term structure and skew structure. So the whole surface is forecasted. And so that's how we could come up with these forecast percentages.
Mm-hmm.
All right. Are you ready to move to D?
Let's do it.
All right. So D is the newest, the newest theoretical value that we've created, ORATS, is D, and it's based on a distribution. ORATS has put together a really cool distribution that's based on, we could almost do a whole show on it, but it's based on historical stock movements that are adjusted for the volatility at the time. So if the stock was really low and the volatility was really high and it moved, in one of these buckets, we kind of adjust it for the implied volatility. That's all I'll say on that. But it's a good calculation.
Right. And so the D percentage itself is you add up all of those buckets that are in the green area, right? And that is essentially it's almost like a probability of profit kind of calculation, right? Where you're like looking at all the buckets underneath the green area.
Not necessarily. You're describing the probability of profit. So you're like, in
Okay.
order to calculate 14%, that's what you do. But to get a theoretical value, you do all of them. So, you have a 0.2% chance of losing, all your premium at these levels. And you can kind of see, at expiration, 48 cents or whatever it's worth.
So is
So
it kind of like an expected value calculation?
exactly.
Okay.
That's what it is. Yeah. It's an expected value calculation based on the distribution and a payoff picture at expiration. It's pretty simple, but again, another theoretical value to make sure what you're paying is reasonable.
So if this is positive, it generally means that the stock's moving in the right direction, or the probability of profit sort of in your favor for this particular trade.
If the D percentage is positive, it doesn't mean it's moving in your favor. It means that the amount of movement in the stock is in your favor, which is probably what you were saying, but just want to be a little bit more specific. It's not a directional thing; it's a movement thing. So the chances of it finishing up, as you say, probability of profit, are higher, and but it also looks at the losses and all those chances. So, so in this case, again, you're going to get some pretty different type of values for these things, but
yeah, I mean it's really just a better probability of profit calculation if you think about it, because probability of profit doesn't take into account historical movement and historical volatility.
right.
It just looks at the current expected value. So
Yeah, that's a good way to put it. I think this is a more accurate probability of profit. And that's the funny thing is, what I've always tried to do as a market maker is take a lot of the assumptions. We know a lot of the assumptions in Black-Scholes are false, right? So what trading is options are a lot of about is finding those assumptions that are incorrect. And one of the incorrect assumptions, is the normal distribution that a lot of these assumptions make. And so if you could make your own distribution, and it's accurate, that's the best way to that's the best way to look at it.
Yeah, we talk about these sort of misconceptions and these interpretations of the Black-Scholes model on our university some more.
Yeah,
because it's definitely a lot of what we do at ORATS is fixing these things.
Right. So let's just wrap up because we're getting to the time. But so what we're saying is what you want to do if you're just looking for a pure forecast and distribution thing. Now, we've used forecasts for a long time, and we've studied them. We haven't put out like huge reports, but we've had people use them and tell us that they've done well with them. But we don't want to make those kind of assumptions right now. But that might be something that we do in the future. But it's we're doing a lot of things here at ORATS. But what we're saying you want to do is get as many things in your favor as possible. And the way to do that is to start with the biggest pie you can. And ORATS allows that by having a stock scanner that helps you narrow down a lot of the symbols, find the symbols that meet your criteria that you think could move, and then start looking at theoretical values. And then you can rank these theoretical values like by forecast, by smooth, and risk reward. So you could sort these to find what the best one is. And you have a distribution theoretical value, you have a forecast theoretical value, and a smooth theoretical value that you should be paying attention to when you're trading. And that's really the purpose of this show, Tyler. And then we did get a trade on in KMB. And what I'll do in this one in KMB is just I'll give myself an alert. So I'll want to trade out of it if you know, we're if we lose 75 or 50. Yeah, so we'll get an alert, and if it's not too wide, you know, so if it goes way wide, we don't want the alert. But if it's a normal width, we want to get an alert and then think about trading out of it.
All right, awesome. Yeah, looking forward to seeing how that trade does in a few weeks.
Yeah.
Well, yeah, thank you, Matt, for sharing your expertise as an ex-market maker and, you know, having these theoretical values of the scanner. I think it's really great for retail traders. And yeah, thank you guys for watching. If you guys have any questions, just leave a comment in the comments on the video. You can also email us at support@orats.com. We also have a very vibrant community tab on the dashboard. If you are a subscriber, you can have other members answer your questions and get some more information on things from there. And thank you, Tradier, for hosting us this week, and we'll be back again next week.
Thanks, Tyler.
Thanks, Matt.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.